right, I think we're live. So let me share this inside of my group really quick if it will let me. Actually, let me do it on my phone. Katie, do you want to just do a quick intro as to
Sure.
who you are and what you do while I do this?
Yeah, so my name's Katie Thomas. I'm a realtor, not a realtor. I am a realtor. That's not my big thing. Sorry. You can tell what I've been working on lately. No, I'm actually a CPA here in Arizona. I specialize in working with small businesses as well as kind of individuals and that kind of stuff. Graduated from ASU. I went straight into working for the big four accounting firms. Was working 8 a.m. to midnight Monday through Thursday and 8 a.m. to 5 p.m. Friday, Saturday, and Sunday, and hated my life. Started working for a small firm, loved it, and ultimately ended up deciding to go out on my own. I liked what I was doing, but I was tired of, I was an auditor. So I'd go in and point out everything everyone was doing wrong, and I got tired of just pointing it out. I wanted to go in and help people fix things. And I loved working with like nonprofits because they were so excited to be doing what they were doing. And I found that smaller businesses are also very excited and they want to do things right. Like that's the thing is, a lot of times I'd go into big corporations and they're kind of like, dude, we don't care. We got too much other things to worry about. But people who want to do it right and are excited about things just really excite me. So.
Yeah, and I actually did a live earlier today speaking about entrepreneurship and kind of transitioning and that being the safe route to go nowadays. So I have just a fun question. You went to Arizona State and I've heard that's a party school. Is it truly a party school?
So that was our claim to fame about 3 years before I started there. They always made sure to clarify that that was self-reported. So it was they had enough people that we had the most people who voted for us from this school. So I didn't.
Truly, was it like a party school?
You could find a party if you wanted to, but show me a college campus that you couldn't.
And so from there you went to work for, you said you were in corporate. So where did you work corporate?
So I started with KPMG, which is one of the 4 largest accounting firms. We audit Fortune 500 companies. And at that point, I was literally working on one client, just one small piece of it. I got laid off because it was, the height of 2008, and I was just devastated. Thought that was the end of it. I'm like, my first job and I'm laid off. This is not a good start.
Yeah, that was my second job actually when that
happened. So my second job was there for about a year and then got laid off again. I'm like, I'm so over this. Actually, they ended up rehiring me at a different location, but I had to re-interview, reapply, all of that kind of stuff. So it wasn't quite smooth. Was there for about 8 years, tried a different firm just in case it was the firm that I wasn't loving. Got recruited out of that one by a brand new startup in Phoenix, and was the first employee they hired, was pretty much responsible for all of their processes, procedures, stuff that I shouldn't have been doing because usually your company already has those in place, but I got to actually, it's kind of like my own company because me and the boss were kind of like, whatever we want to do. A little after that, about a year and a half later, I had my 6-month-old and we were on vacation, and I got a call from that company and they said, we're closing down the shop, so don't worry about coming back to work.
Oh my gosh. Yes, it's happened to me twice as well, and I know how devastating it is. So then you transitioned over into being a business owner, and you're working with your father as partners. That's awesome.
He got laid off 6 months before that from his job of 35 years. So we were both like, you know what? If there's ever a time to do it ourselves, this is it. So let's just do this. And we love it. It's been a great partnership. A lot of he kind of lets me run things, and he's just using the business to do what he wants to when he doesn't want to be retired.
That's awesome.
Yeah.
All right, cool. So let's get into the tax stuff. So taxes are my least favorite thing in the world because I never want to pay them. I know we spoke about this.
Yeah.
Sorry, just got a notification. Yeah, so as I mentioned, when it comes time to paying taxes, I'm like that last minute person. Yeah. One part of it is I don't like numbers. I'm not good at them. And the second part of it is I just don't want to pay them. Like I want to save my money, and I feel like This is a good thing to talk about now because
Yes.
before you know it, it's going to be tax season and, people like you are going to be busy. So it's good to have our ducks in a row before last minute. So I guess you have some slides for us.
Yeah.
Let's start with those.
Okay. Let's see. So before we start, I have to give my disclaimer. It's very standard that I'm not actually providing tax advice or anything specific. If you find that this applies to your situation, actually talk to your financial planner, CPA, professional, be like, hey, I heard about this. How does it work for my specific situation? You can't rely on what I just told you in my webinar. So that's my caveat. We're good to go. So like I said about me, that was my fun fact. I'm actually an accountant because the marketing department wouldn't let me double major. So one of those kinds of things. But the biggest thing I know that we talked about was you've got a really unique group in that it's both employees and independent contractors.
And some side hustlers too.
Yeah, and those are kind of fit both. And the biggest thing I find is people don't understand that there's a difference. And they also don't understand that you don't get to choose. Like, this is not something where you just kind of go to your employer and be like, I'm thinking. But the biggest thing is an employee is, you can see they're paid hourly or salary. The employer pretty much controls how they do what they do, all of that kind of stuff. An independent contractor is kind of like someone that you would, it's very clear when you're like, oh yeah, I'm hiring a graphic designer who's going to do this one small project. But like in accounting, I can sometimes be like, there's ways that I can structure it so I'm in a contractor position or as an employee. And so there are there's a lot of people moving to this where it's more of an independent contractor. They talk about the gig economy. If you are doing a gig, you're more likely an independent contractor. And the biggest difference between the two is that as an employee, your employer pays half of your taxes, your Social Security, your Medicare, and those kind of things. As an independent contractor, you're responsible for everything, taxes, insurance, all of those good kind of things. And like I said, a lot of people think that you can just go and be like, I want to be an independent contractor. It doesn't work. There's actually very specific tests that the IRS puts out. It's long, boring, and I won't get into it. But at the end of the day, if the employer misclassifies you, they could get in really big trouble. So a lot of them are going to be very, very strict about that. And for those who don't know, if you're an employee or an independent contractor, it comes down to what you get at the end of the year from the person that paid you. If you're getting one of these W-2s, you're an employee. If you get a 1099, you're a contractor. So once you figure that out, it's easy to know. Biggest difference is as an employee, there's not so much tax strategy that you can have. But as a 1099 contractor, you're running your own business. So there's a lot of different things that you can do to get creative, legally creative in there.
Right. And you could actually be both, right?
Yeah. So I actually was working for a real estate brokerage, and I was paid as an employee because I was doing their accounting. But if I sold any houses, I'm paid as a 1099 contractor. So even with the same employer, you can have both. That's not very common. But a lot of people who are working a 9-to-5 job, they're going to be a W-2 employee. And then if they have a side hustle, they're probably a 1099 contractor on the side.
Yeah, got it.
So, yeah. So first we're going to talk about employees, because I know that was, they're easy to kind of knock out. And the biggest thing is this W-4. That's the form that you filled out when you first signed up for your job. Theoretically, you're supposed to update it every year. Not all of the employers are the best at this.
Right.
The biggest thing on it is just, a lot of people think that if they say, so line 5 here, it says the number of allowances you're claiming. People think they can get real creative like that and avoid taxes. All it does is means that you're not withholding enough at the end of the day, and you're going to owe taxes at the end. And the killer thing about the IRS, and I just sat down with a client yesterday, they like their money as soon as it's owed to them, which does not mean at the end of the year. It means when you earn it. Mm-hmm. So if you don't pay if you don't have your employer withhold enough taxes, you actually owe penalties on what you owe at the end of the year.
So on top of what it is that you already owe, you can owe a penalty as well.
Yep.
Oh gosh. Okay. We want to
Penalty and interest. Like they're like, no, you owed us this money back in June when you earned it, not in April when you filed.
So if you think you're outsmarting it and adding more allowances to pay less every week or month, it's going to come back and bite you.
Yep.
Okay, got it.
So that being said, sometimes you find yourself in a situation where you need the cash, and that's the easiest way to get some of it. You can up your allowances and they won't withhold as much. Biggest thing with that is kind of A, keep that to a minimum, and B, don't think that you're not going to end up paying it at the end. But a lot of people love when that if they're paid biweekly on that month that they have 3 paychecks, right before that 3rd paycheck, they'll up their allowances so they don't have much taxes held out of there. And then before the next paycheck, they jump it back down.
So you can change this as often as you want by law?
Theoretically, it kind of depends on your employer and what their policies are. I know if they're working with an online system like ADP, you can literally change it each paycheck.
I remember being allowed to do that. I didn't do it often, but when I needed to, I just asked them where it is that I could do it, and it was ADP, and I went in there and just changed it online. I have to actually fill out the form again.
Yeah. So the important thing is to know when your pay cycle, like when they run payroll, because even if you're paid on Friday, you might have to have it in before Wednesday or even the week prior. So that's the one caveat if you are going to switch it, is to know your employer's policy. Got it. But the biggest thing is the employer can't give you any kind of guidance on this. And to be fair, this what we're showing on the screen is literally just the piece that goes back to them. There's a second page to this, which they call a worksheet. And it's literally, the IRS has asked you a bunch of questions to kind of help you calculate this kind of thing.
Yeah, I know. When I worked in HR, even though I worked in HR, everyone would come to me and ask me, like, how do I do this? And that's the one thing we always said is, like, we can provide this to you, but we can't give you any kind of instruction. And that was always what was told to me as well. And it's kind of like, well, how do I know how to do this?
Trust me, we all ask that question. We're like, well, what do you mean you can't help me? But by law, and that's the thing, is a lot of people think the employer is just being mean, and they're not. They're legally not allowed to. Even if they think they can understand it, they don't want to get into that. But that worksheet's pretty self-explanatory. So if you just read through it, it asks you, do you have any children that you're claiming on your tax return? And yes, no kind of thing. So it's fairly self-explanatory. For the most part, if you're married and only one of you is working, then the working spouse would have 2 exemptions. If you're married and you're both working, you don't want both of you to have 2. You want 1 on each kind of thing. Or you can strategize and do 2 on one and none on the other, but that's, for the most part, the general rule of thumb. Okay. So the other thing too is if you're kind of going through and about midway through the year, you're kind of like, okay, let's take a look. You can roughly estimate where your taxes are going to fall, assuming, all things consistent. And if it looks like you're paying too much, then you can change it. Or if you're not paying enough, you can change it as well. So that is the benefit of changing mid-year. You're not stuck with what you committed to. It's not like your benefits from the beginning of the year. Right. So I don't know if this is like a stupid question, but how would you change it? Like if you say have no children, right? Yeah. And you want to change it, do you change it to 1 or 2 or 3? Like how do you do Generally, there is no rule to that. Like there's no good guidance, and most tax professionals are going to tell you to just leave it where it is. Right. That being said, my husband, it was funny, he'd always come home and be like, oh my gosh, all of the guys that I work with, because the 3rd paycheck, they ran in and changed their thing, and they jumped their allowances to 10. Yeah, my boyfriend has like 10 allowances, and it's like, okay. Yeah. So, but that was funny. Like I said, I talked to a client yesterday, and she jumped hers to 10 because she wanted the cash. And she didn't change it back, and then she underpaid by about half of her tax because she wasn't withholding taxes for half the year. Right.
So
So
you could do it, just you have to be careful and
yep.
be aware, not forget to change it back and all that good stuff.
Exactly. So it's one of the, most people tend to only change it if they know they've had a change in circumstances. You know, you have a kid, you get divorced, life events,
Right.
or if that third paycheck is kind of when everybody likes to play with that one, just to max out the cash.
Well, when you do it, you can actually see what you get in the paycheck, and if it's not enough, you can up it for the next paycheck and kind of play with it, that kind of thing. Right? Okay, got it.
But for the most part, most people set it and forget it, and that's it's just the safest way. Make sure you follow that worksheet and then fill it in and put it away. And then if at the end of the year, you can kind of gauge, okay, I had one exemption and I'm getting this huge refund. I need to do something. Or I had one exemption and I owe a huge amount. Something's not right. Like at the end of the day, what you get and what you pay should net to roughly the same. So that's where sometimes you have to spend that first year to figure out what you've got going on.
Got it.
So that's your W-4, and that's really the most important thing when it comes to an employee and managing their taxes, because at the end of the day, your taxes are withheld for you. So if you don't have it withheld properly, that's where most people get in trouble, as opposed to you didn't pay enough or you didn't, that kind of thing. So
got it.
This is just a quick info of what you'll need. It's really pretty basic, and everyone kind of gets scared because they're like, oh, it's a tax form. Hopefully you know your name and address, your social security number, and is anyone else claiming you as a dependent? I know a lot of new kids, especially with the tax law going up to 26 sometimes, that can get them in trouble. You know, they think they're not being claimed, and they are, because, you know, their parents are still paying for everything. So just kind of talk to your family. And then that head of household. So if you're divorced and you have children, then you can file as head of household if they're primarily with you. There's a couple other tests to meet, but instead of filing, it's not just single or married. There is that extra head of household. So
got it.
This is the great one that I said. You know, if you have kids, you can have 3 allowances, possibly 4 if you've got 4 family members. Bear in mind, these are very basic, high level. This comes directly from the IRS. So if you've got a lot of other things that are going to knock down your expenses, or increase your deductions and that kind of stuff, this may not actually apply to you, but that's why I'm saying that first year you kind of just run with it and see where it lands, and then you can kind of step back.
1 second. You can keep going.
So for those that are still live, yeah, the biggest thing is just kind of see where it is. And then, like I said, mid-year, you can always run your numbers through a quick program and kind of see where it's going to fall out. And if you're projected to have a big refund, then we can adjust. So that's the nice thing. So this, like I said, if you withhold too little, you get the large tax bill at the end of the year. And if you withheld too much, you gave the government an interest-free loan. And I know so many people are like, oh, I got like this massive refund. It was like $10,000.
They're excited about it, yeah.
I look at them and I laugh, and I know I'm one of the only ones. I'd much rather have to write a super small check, because don't get me wrong, there's nothing worse than writing that $10,000 check to the government. But you getting that money back, it was your money all along. You just weren't able to earn interest. And I know that bank account interest is like piddly right now, but we talked kind of about the missed opportunity to invest, not just in stocks and bonds, but in yourself, in your home, in your training, and that kind of thing. So this is what we said, investing in my career.
Yes.
Yeah.
So this is where you are paying, but not overpaying, right? So these are the things you can invest in instead of getting one lump sum at the end, and a massive refund. These are the ideas of things that you can actually invest in all year throughout without having that big sum taken out.
Yep. Yeah, as great as it is to get that $10,000 check and finally be able to go afford the car, imagine what you could do if you were getting this training and improving yourself. Like you could go get the raise where it would just be, you'd be earning more kind of things. You could get a better job, that kind of thing. If nothing else, improve yourself so that you can just do your job better. So the other one is join networking groups. Those can be expensive, but if you've got some money and you know you're not going to have as much at tax time, go meet people, start that side hustle.
Yeah, and for me, masterminds have been huge.
Yep.
About going to a Tony Robbins event at the end of November. He's coming to New Jersey, and that's like $600. So that's something I want to do. And you know, if I'm taking taxes out and I'm an employee, that's not something that I could do. But then if I am doing this properly, that's something I can do, and that can, you know, just be life changing. So
exactly. So there are a few other ways to minimize your tax liability as a W-2 employee. Like I said, it's not as robust as if you're a contractor running your own business. But the biggest thing is just keeping good records. And this applies across the board. You know, keep those receipts. Keep your, and have a smart place. Don't just dump them in a shoebox, that kind of thing. The crazy thing is with the Tax Cut Act that passed at the end of last year, there's still a lot of confusion and concern about how it's actually going to fall out, largely because there's certain provisions in there that even the IRS is kind of like, we don't know what the lawmakers were actually trying to say. So we've run scenarios. I've been in a lot of training classes, and there's two camps, one where it hurts and one where it helps. And for the most part, though, it hasn't been significant. $500 here and there, don't get me wrong, that's nothing to scoff at, but we're not talking like someone went from a $10,000 tax owing total and to suddenly owing twice that. I mean, at the end of the day, it should shake out more or less how it is. The biggest thing that is hurt this year is if you're an employee and you had unreimbursed job expenses. Those are no longer tax deductible. And I know a lot of employees were kind of really shocked to hear that and are kind of like, how do we fix that? You know, I work with a bunch of mortgage professionals, and obviously they take their clients out and those kind of things. No longer tax deductible, and so they're kind of hurting. But you can do other things. Your IRA retirement accounts, your 401k, if your employer has it, do that, because that reduces your taxable income, which means you pay less taxes now. You pay it when you take it out, but for the most part, that's something to worry about down the road, and so important. If you have a FSA or an HSA, so a high deductible plan, you can have an HSA. Put that money in there, and then you can pay your medical expenses with that. And it's the same with the child care spending account. So we just put our 2-year-old into preschool, and we had the money come out pre-taxes, which is awesome, because at the end of the day, I'm going to pay that money one way or the other. So the governments realize they need to help support that. The other one that everybody laughs about is have a baby. Literally.
Every year my accountant asks me, like, okay, did you have a baby this year? And I said, unfortunately no, but we'll try next year.
I'll work on that for you. No, when we were going through school, it was always the big joke that literally as long as you had that baby on December 31st, you got to claim the exemption for the entire year. So that was our big joke.
You have to actually have the birth before December.
Yeah.
Okay, got it.
But you want to have it on the 31st, because that way you get a whole extra year, as opposed to having it on January 1st, where you've had all the expenses as well.
I'm already too late for this year. We have to try again next year.
Next year.
Yeah.
So the other thing that I'm going to mention is that you need to talk to your tax professional. You know, they're going to try and ask you all of the probing questions, but throw things at them. And even if you're like, they don't care, throw it at them, because they might surprise you and be like, oh my gosh, I wish you'd told me about that, or last year or something, because there are a lot of things that they might not think to ask you because they don't know your whole situation. A good professional.
charitable contribution. So for example, I am actually getting rid of my couch and we're getting a new one. How do I, like, what do I do with that? Like, do I get a receipt from Goodwill? Like, how do you do that?
Yeah. So if you're giving a contribution of any kind, a charity should give you a receipt.
Okay.
The big thing with that is make sure it's a 501c3 status charity. You can look that up online. Don't let there's this big scam going around where they're calling you and they're like, oh, we're collecting money to save the babies, and they give you this spiel. They're not actually a tax exempt charity. I got one and I looked them up. I was like, can you provide me your employer identification number? And I ran them through it, and they couldn't ever. So if someone calls you soliciting and you don't recognize the charity, like it's not someone that you've done business with, or that Children's Museum of Phoenix, we know that one. So I'd be fine if they called me, but like the random Timbuktu place, you're like, but they're gonna all give you they're gonna give you a receipt.
Okay.
Anything over 250, they're legally required to give you a receipt, but even under that, they're gonna give it to you. If you're gonna claim more than $500 in non-cash contribution, then you have to also get like an appraisal or come up with some way to value it. Non-cash contributions kind of get a lot trickier, but if you're gonna donate something like a couch, call Goodwill and be like, hey, what do you need from me? They won't put a value on it, and they're not allowed to put a value on non-cash contributions. But they will give you that receipt and you can put the value. And the biggest thing that we're hearing from the IRS is to actually take pictures. So if you take a bunch of your kitchen stuff and you donate it, the IRS wants to see a picture of that to support what you gave.
That is an amazing tip.
Yeah.
So very valuable information.
And these are things that we're all learning. A lot of tax actually comes out of either tax law or IRS cases. So just because we have the code and here's what this says, here's what the actual law ends up being. So it's interesting.
Interesting, yes.
Yeah.
So that's good. There's more, right?
That's really it for employees. Biggest thing is definitely the 401k, especially if your employer is matching any of your contribution. I know a lot of people are like, well, I need the cash now. And I respect that. But at a bare minimum, you need to be earning that match. Otherwise, you're giving away free money from your employer. So the contractors is the next one. We also know them as entrepreneurs often. That's something I've run into is a lot of these contractors, because of how they're running things with their company that they're contracted with, they forget that they're actually running their own business. And then they get themselves in trouble at tax time because they're like, well, nobody told me I should be doing that. So that's kind of where my heart and passion came in is, hey, you guys are running a business. Let's be smart about this. And let's have this discussion before the end of the year, because after that, I'm just a historian. All I can do is report what's happened. I can't actually help you avoid anything.
Right.
So few things. There's different ways to legally set up your entity.
Yeah, I actually just did an LLC last week.
Yeah, and this gets into legal. So my insurance company is going to tell me that I should tell you to contact an attorney to get good advice. But for the most part, you're probably going to be an LLC or a sole proprietorship. So if you're working by yourself, your default a sole proprietor. You actually have to set up a corporation or an LLC to have that extra status. And the reason that you see that in bright green is because it's actually a great way to mitigate some legal risk. If you're just a sole proprietor and you screw something up, they sue you and they have access to all of your assets. If you're an LLC and you screw up and they sue you, they only have access to the property of the LLC. So it's more about protection than anything. The biggest thing that I run into is everyone's like, oh, well, how should I be taxed? As an LLC or an S Corp? They're not mutually exclusive. So this is the legal setup. And then there's the tax setup. And this you can see that red line is that an LLC can actually elect to be taxed as an S Corp. So what this does is it gives you some options to deduct your payroll taxes. So like I said, a W-2 employee, your employer is actually paying half of your FICA taxes. as a contractor, you're responsible for all of it. So if you're earning more than $60,000 in a year, you probably want to talk to your CPA and talk about setting up as an S Corp to save that money. Because at the end of the day, you run things through payroll through the company. Much below 60,000. So if you're only earning about 40,000 on the side, it may not make sense to be an S Corp. Just the cost of doing those payrolls might offset any savings you have in those tax deductions. So.
And what is the difference between, there's an S Corp and a C Corp, right? There's
Yeah.
two kinds. What is the difference?
So a C Corp, an LLC cannot be a C Corp. A C Corp is a completely standalone. The biggest thing with them is they're subject to what's called double taxation. So they get taxed at the corporation level. So if they make $10,000, there's income tax on that at the corporate level. And then if they pay any money out to you as an owner, there's tax on that as well. So essentially you're getting hit twice. Whereas everything else, it all flows through and it only gets hit on you when you get the money out of the corporation.
Got it.
So very few people are going to do a corporation. Those are, the big ones, obviously, like Nike is a corporation. They can't be an LLC because they're too big. They have to incorporate to be part of the S&P 500 and all of those, the Fortune 500 stuff. But most corporations are big. So you're not going to see too many entrepreneurs being a corporation. Yeah. But that is the thing, though, that there's no downside to being an LLC. Just because you're an LLC doesn't mean you have to be an S Corp. You can choose to be an LLC and still be taxed as a sole proprietor. The only difference is whether it's a separate tax return. So an S Corp does have an extra tax return to file, but it still all flows through up to your tax return where you pay the tax on the income. So.
Got it.
Yeah. And for the most part, I haven't researched every state, but I know here in Arizona, it's super easy to set up an LLC. And a lot of tax preparers can help with that as well. So definitely talk to someone in your state specific because there are certain rules, or someone who does know your state. And if they're, I wouldn't be comfortable doing like New Jersey because I don't know that state, but I can certainly refer to people who do. So my top 5 tax tips, and this kind of applies to everyone, but especially for those who are running their own business. The biggest thing is keep your business and your personal separate. Not just your drama, but like all of your money and everything. So get separate tax accounts, bank accounts. So even if you're not going to have a separate corporation, you're just going to do it all through you, that's fine, but still keep separate bank accounts and try really, really hard not to use the wrong credit card kind of thing.
That's such a good tip because I was for the longest time like co-mingling, is that
Yeah.
what it's called? And they told me in the bank, you can't do that.
Yeah.
So what I did is I, have my EIN numbers, what you need, right, to set
Yep.
up a business account. And then you have your personal account, and I do it in Chase.
Yep.
And then it's very simple. They just set it up for you. You just tell them, here's my information, here's like my LLC, all that good stuff. They set up your business account for you. Then you have a debit card for each one.
Yes.
And if you're doing something for your business, you pay with that card. If you're going out doing your personal stuff, have your own separate, like regular debit card, right? So that's how you do it separate. Okay.
Yeah. And the cool thing is if you can get it at the same bank, then you can literally just transfer funds out if you need money.
That's what I do. Yeah.
It doesn't have to be separate banks and all that. Like, we're not making this difficult, but just keep them separate.
Yeah.
And a lot of people don't. And the other thing is, as you start learning some of the things, like all of your auto expenses should be run through the business, even if there's some personal, because at the end of the year, your tax professional can pull that out.
Oh, that's interesting. I did not know that.
Well, it depends on if you're doing mileage or actual expenses, but for the most part, run it all through your business and then they can pull out the personal portion. That said, they don't want to see your manicures going through your business, and the IRS is very clearly said those don't
But
happen.
why? You know,
Unless you're a hand model, then you might be able to actually claim it. But for the most part, those kinds of things. So that's kind of where the whole business personal kind of gets a little blurry, where it's those mixed expenses. But if it's distinctly one or the other, and then the big thing is if you do accidentally commingle, you want to get that fixed right away. So if you use the business card for a personal thing, we need to reimburse the business. Or if you used a personal card, the business needs to actually reimburse you. And this is critical, like do not commingle if you are an LLC, because at that point you've totally invalidated any of that legal protection.
And so if you have your business and you're getting paid through your business, then do you pay yourself and just send yourself the money? Is that how you do it? Yeah.
So if you're not doing an S Corp, then you don't really have to do payroll. You don't have to set up a payroll and run it separate. You do need to be making your quarterly or sometimes monthly tax payments, essentially as if you were an employer and paying employees, paying like yourself as an employer, even if you're not paying actual payroll. You know, for me, I haven't hit that point where I'm running it as an employee. But I am making my quarterly payments as if I were. And the cool thing is if you're using something like QuickBooks Self-Employed, it will actually show you what you owe on a regular basis, so you can keep track of that. General rule of thumb is about if you're not using a software that's calculating that for you, always withhold 30% of your checks just to cover everything and be safe. That's generous, but I'd much rather have more money left over than sit there and have to be like, I need to take out a loan to pay my tax bill.
Got it.
But that next one is be strategic. So I sat through a webinar, and I'm going to share this with everyone. So if you're on Instagram, Tyler McBroom with Measured Results, he's actually out of California. He drops the most amazing tips on how to make your lifestyle tax deductible. So ways to take a vacation and have it be expensable. You know, you work on a Friday, then you stay Saturday and Sunday, and then you work on Monday, and then the whole trip gets to be deductible. Stuff like that.
Awesome. What was his name again?
Tyler McBroom.
Okay, got it.
And I'll post that in the group as well. So
I'll follow him.
Yeah, and just he drops stuff that even I'm sitting there going, I would have never have thought of that, but that's genius.
Yeah.
But he's the one who really kind of came up with this thought of your lifestyle tax, make your lifestyle tax deductible. And the best one is, like, for me, I have a doctor and they're up by one of my clients. So I always schedule my doctor's appointments right around client visits so that I can deduct the mileage to the client.
Smart.
And then it's just that little bit difference that I don't get to, as opposed to having to make 2 separate trips.
So these are like little hacks.
Yep.
Yeah, that's great.
So stuff like that. The other thing is, as an entrepreneur, as a self-employed kind of person, don't neglect your retirement. I know it's super easy to be like, I need the cash, I need it now. But unless you want to be working for the rest of your life and not retiring, you need to be treating it like you had a 401k or your employer offered that kind of stuff. There we go. Have a good CPA. That a lot of that is you need someone who's going to be talking to you now. Maybe not quite now because they're getting ready to file all of the extensions, but in June, July, August, they're reaching out to you saying, hey, where are you at? What have you got going on? Has anything changed? Or even more important, that someone is, that you can call them and be like, hey, I'm trying to do this. What should I know? There's nothing worse than me getting some client stuff at the end of the year and they're like, oh yeah, and we did this. And I was like, well, you should have called me because we could have done it differently and made it so much better and saved you thousands of dollars. And they look sick. And it's like, well, I've told you, call me, like 5 minutes, 10 minutes. It's not like we're going to turn this into a bill fest.
Right.
Thousands of dollars. So you need someone who's willing to be a trusted advisor. That's really what it comes down to. Because at the end of the day, if you have a good CPA, they're worth every penny you pay them because they're going to save you at least that in your taxes.
I agree. Yeah.
And then the top tip that every tax preparer will tell you is have a good set of books. your shoebox full of receipts is great, and I much prefer that to I don't know. But it's worth it to get a system. Excel is an option. We don't love it, but QuickBooks is actually pretty cheap, and they have a new program called QuickBooks Self-Employed, and it's fantastic. It's super basic. It's only about $10 a month.
Okay.
And the thing that I love about it is twofold. One is it tracks your mileage if you're using your smartphone, and two, you can literally like buy something. So I took a client out to lunch the other day. I got the receipt, I wrote right on it, and I snapped a picture of it, and then I threw the receipt away because it's saved in
that's awesome.
So.
And your CPA will love you.
Yes. And you can be making educated, informed decisions throughout the year. So, you can look and see, okay, well, based on this June, July, kind of like with an employee, you want to sit down and be like, okay, where am I at? What's my projected tax thing? And then you can be like, oh, hey, it looks like we've got some extra money. Maybe we could afford to buy the new car for the business, or invest again. Take that money in and invest it and be smart about it. So yeah, that's my stuff. Here's my contact information.
Yes. So this is how people can find you, right?
Yeah, I'm happy to answer any questions, especially about anything I covered.
Awesome. Yeah, we'll be reaching out to you soon. It's time. Awesome. So thank you so much, Katie, for being here and doing this live. This is very informative. A lot of information to take away. I'm gonna have to rewatch this video.
Yeah,
thank you so much for being with us. And yes, everybody, talk to Katie if you need any tax advice, and she'll be happy to refer you, even if you don't live in Arizona. And I know actually I have a few people that do live in Arizona. Thank you so much.
You're welcome. Thanks, Irina.
Bye.